In just 3 days, this Wednesday, the U.S. government is going to make an announcement that's going to shock the world. Now, I want you to understand, the Federal Reserve is not tightening anymore. And yet, at the same time, liquidity problems are persisting. SOFR volumes are up, and the financial system is hovering on the edge of a breaking point. And the Fed, they're getting scared. In fact, one former insider believes Jerome Powell is extremely likely to announce the money printers turning back on next week with $45 billion in Treasury bill purchases to start in January. They're not going to call it QE. They're going to call it reserve management purchases. But let's be absolutely clear. It's a direct liquidity injection, and this former New York Fed repo guru, he's the guy that's called the early into QT perfectly 2 months ago. He says it's happening. And when the Fed floods the system again like this, stocks don't just rally, they tend to go parabolic, but only for a little while, because the bill, it always comes due. It first starts with stagnation, and we're already in the early stages of that. Then it slips into a recession where we could be facing another financial crisis. In fact, this is the biggest pivot nobody is warning about, and I'm going to show you exactly what you need to do to profit from it. Plus, tonight's show is brought to you by Focus Graphite. You can find them on the TSXV under symbol FMS and on the OTCQB under symbol FCSMF. And they just secured up to a $14.1 million government funding round to advance their chemical-free purification technology for next-generation batteries and aerospace applications. Stay tuned to the end of the show or check out that pinned comment or description for more information. Now, I want to set this up properly because it didn't come out of nowhere. Now, let's go back 2 months ago. The repo markets, we're talking the plumbing of the financial system, it started locking up again. SOFR and tri-party rates, they started spiking daily. And New York Fed repo guru Mark Cabana, he's over at Bank of America now, said reserves are no longer abundant. The Fed, they need to stop QT early. And what happened? Powell caved. QT officially died on December 1st. But the problem is, the stress, it never went away. Banks at the time tapped $26 billion from the Fed's emergency repo facility, the second highest since the 2020 crash. And what this is indicating is that rate cuts and stopping QT didn't work. The pipes of the financial system, they're still clogged. But the real announcement, the big bombshell, is going to be $45 billion a month in T-bill purchases, plus term repo operations to grease year-end liquidity. And for those who know what's about to hit, it's going to create an opportunity to put real dollars in your pocket. Now let's dive in. First, let's turn to Financial Times, who nailed it this week. They said, rest in peace QT, long live reserve management purchases. And they say repo volatility is screaming that the balance sheet has to expand again and fast. Because the problem right now in the system is money. There's not enough of it to go around. And that's a clear sign that money now is getting uncomfortably tight in the repo market, where rates have been unsettlingly volatile lately. Given the global systemic importance of the $12 trillion U.S. repo market, is not something the Fed is likely to tolerate for long. Translation here, those that have money, they don't want to lend it. And those that need money, they can't get it unless they go to the Fed. And this has serious implications for our financial system, because if we see forced selling and it occurs during tight financial conditions, asset prices, they can crash overnight. We've seen this happen before. And we see this in the reference repo rates outside the target range risk weakening monetary policy transmission and point to the need for reserve management purchases to begin soon. And what was supposed to happen after the Fed cut rates and announced the end of QT was that repo rates were supposed to drop and settle in line with where they're supposed to be. The problem? They stayed elevated. But is this QE under a different name? Well, yes and no. Firstly, most important, while QE involved buying long-term bonds, reverse management purchases only involve buying short-term government debts known as Treasury bills. So the Fed is going to downplay the inflationary effects of this, because if inflation shoots higher and wages continue to stagnate and layoffs accelerate, as I believe is likely to happen, we're going to head right into a stagflationary recession, and it's coming early next year. And the Fed, they don't want to take the blame for this. So what Powell's going to likely say is a financial piping nowadays needs a certain amount of money sloshing around to make sure things operate smoothly. Since last autumn, there have been mounting signs that maybe what was once considered a, quote, abundant level of reserves was now becoming merely ample and could quickly become, well, uncomfortable or scarce. But here's the real truth. There is no formula. There's no explanation. There's no third-party validation. And prior to 2008, there were absolutely no reserves in the financial system. And guess what? It worked just fine. Today, the Fed claims we need $3 trillion. And this chart of reserves and depository institutions in blue shows at the moment reserves fell under the 3 trillion mark. You can see that red line there. Liquidity issues, they started to pop up. And this chart of the secured overnight interest rate, or what's called SOFR, is a broad measure of overnight secured borrowing costs, and the tri-party general collateral rate, which is a slightly narrower measure of one segment of the repo market. We're looking at that versus the corridor formed by the Fed's 2 main interest rate tools. See how that blue line pops over the red line? That is a sign of tight money. So the issue is both SOFR and TGCR rates have occasionally jumped out of the corridor for over a year now, but only around the end of quarters when money is usually tight for a variety of reasons. But the move, they've been violent, and they've lasted into the first of the month. And the issue here you have is when the plumbing of the financial system locks up, you get financial crises, asset prices crash. And again, this isn't something the Fed wants. And that's why BofA's Mark Cabana believes the Fed will begin RMPs as early as January 1st, since funding markets already seem to be pretty tight. And they may do some backfilling of money, which he believes is appropriate. And if you think about it, with Christmas and the New Year fast approaching, the last thing the Fed wants is a liquidity event that sends stock prices crashing. In fact, there's some evidence the Fed is planning to announce RMPs as we look to New York Fed President John Williams. He said literally 2 weeks ago, I expect it not to be long before we reach ample reserves and start growing the balance sheet. That's Fed speak for liquidity is coming into the system. He goes on to say an ample reserve strategy and in no way represent a change in the underlying stance of monetary policy. Translation here, reverse management purchase, they're market neutral. They won't cause inflation, and not that the Fed really has any clue here. But this is all about the blame game that if inflation goes up, it's not because of RMPs. New York Fed Markets Chief Roberto Perli even joined in. He said even blunter, rising funding costs means we won't have to wait long to start buying assets. Even Powell said that reserves will need to grow to keep up with, the size of the banking system, the size of the economy. So we'll be adding reserves at some point. So here's what Mark Cabana says we're looking at. $45 billion a month starting in January, and possibly, get this, $100 to $150 billion one-time true-up in the first quarter. And that's half the pace of the regional QE. This is pure bill focus, meaning it's going to go straight into risk assets. Let's look back to former Fed Chair Ben Bernanke. He said when he launched QE1, it was money printing. Now, we know it really wasn't, but the markets bought it. And you can see the effect that it had on stocks then and what it's likely to have now. Let's take a look at this chart of reserves of depository institutions in blue, now overlaid with the NASDAQ 100 in red. You can see when the Fed prints or injects money into the financial system, what happens? Stocks, they store. So in the short term, markets are likely to front run this hard. Expect a monster rally into year end and potentially into Q1. But hang tight, I'm going to show you what could derail that and fast. But Citadel's Scott Rubin are already saying, man, they're max bullish. They think stocks are going higher. He said the supply and demand mismatch is tuned decisively in favor of the buy side. And if indices push to new highs, FOMO-driven chase behavior could accelerate. And the machines, well, on top of that, they could be big buyers here on a rally. Because commodity trading advisors or CTAs, vol control strategies, and risk parity strategies are rebuilding positions as realized volatility declines. And they're not the only buyers. Another source for stocks is reopening of the corporate buyback window. Citadel estimates roughly $5.3 billion of daily demand into the close of the calendar year. So when you tack on seasonal factors, you've got the recipe for a stock market melt up here. But before you start celebrating, if Powell delivers a hawkish cut, Goldman warns it could hammer small caps. Why? Because it's all about the labor market. And think last month, what happened? ADP said small businesses slashed 120,000 jobs. And if the holiday season is the bust, and that's what the Gallup poll is suggesting, is consumers pull back spending by upwards of 37%, then that number, the 120,000 job loss, is going to look small compared to what's coming in the first of the year. Because if the labor market goes, it will be the biggest rug pull for the stock market since the GFC. And this chart of the unemployment rate in blue versus the NASDAQ 100 in red proves it. Because every major bear market since the GFC began with unemployment line turning up. And one sentence from Powell changes the narrative from liquidity party to hard landing overnight. So yes, monster rally probable. But one wrong word and the rug disappears, and that's why what you do in the next 72 hours matters more than what the Fed says. So let's bring this full circle and answer the one question that matters more than anything else. What should you be doing? Because let's assume that BofA's Mark Cabana is indeed right. And his track record, well, it's pretty solid. It proves it. Fed Chair Powell is going to cut rates by 25 basis points on Wednesday. He's going to announce reserve management purchases to begin in January, upwards of potentially $45 billion a month. Remember, that's half of QE1 and possibly term repo. What's the difference? Right now we have overnight repo. Term, you're going to get longer than a day, and that's going to keep the system juiced until year end. And don't look for Powell to upset the markets here. He knows that high net worth Americans are driving most of the spending, and he needs to keep them spending at any cost. If markets go down, they're going to pull back too. Now expect him to express concerns about the labor market and that the underlying issue isn't monetary policy, it's not interest rates, it's tariffs. And that's a key point because he's likely to push back on a January cut. And if he does, that gives you the green light for stocks. But I don't want you to get complacent because lower rates usually mean a weaker dollar here. And that could put upward pressure on the yen and threaten to blow out the yen carry trade. You want to rent this rally, you don't want to own it. So you want to watch the labor market data like a hawk. You want to watch the yen, because if you see further signs of weakness, well, what it means is you need to keep your stop losses tight here. And if company layoffs and announcements start hitting big in the first of the year, it usually signals a peak is in and the next bear market is here. Now let's talk about some opportunities, because we know when the yen carry trade burls up, it's big for mining stocks. Let's turn to our sponsor for today's show, Focus Graphite. Again, you can find them on the TSXV and the symbol FMS, and on the OTCQB and the symbol FCFMF. And they're a game changer in the world of critical minerals. They're developing two massive high-grade graphite projects in Quebec, Canada, and their tech is set to shake up defense and clean energy. With China tightening exports on graphite and battery materials, North America needs secure supplies more than ever. And Focus, they're stepping up big time. Check this out. Their Lac Knife project is North America's highest grade natural flake graphite deposit at around 15% graphite carbon. A fresh feasibility study shows a 27-year mine life, pumping out 50,000 tons of concentrate yearly with a net present value of over $500 million and a quick 2.8-year payback. That's low cost, high quality stuff that's perfect for batteries and military gears. Then there's Lac Testapisca, one of North America's largest graphite resources, with an indicated 59 million tons at over 10% grade, and a bump in those numbers is coming soon. These projects put Focus way ahead of its peers on grade, meaning better efficiency and premium products that crush the competition. Now what's super exciting is Focus just landed up to $14.1 million from Canada's government to build a demo plant for their green chemical-free purification process. It hits at 99.95% purity, even nuclear grade at 99.999% without nasty acids slashing environmental impact. Plus, with U.S. tariffs on Chinese graphite skyrocketing to 720% and NATO calling graphite a very high risk for defense like fighter jets and submarines, Focus's North American supply is a total win for security and sustainability. Now get this, they've already proven their graphite is in a real hypersonic rocket launch for aerospace, and early battery test shows a 26% boost in cathode density. Their patent-pending silicon-enhanced tech is cranking up battery performance, with more grants like $300,000 from IP Ontario fueling the fire. And fresh off the press, Focus is pushing forward with key environmental studies as a Lac Knife, like air dispersion modeling with WSP to manage dust, and a hydrological study to redesign tailings and wipe out mine drainage. These steps tackle ministry feedback, lock in sustainability, and speed them towards full permitting by addressing every eco detail with top-notch science. Compared with peers and higher market caps, Focus's elite grades and innovative tech scream massive growth ahead. With permits in the near horizon, resource boosts in early 2026, and partnerships brewing, the momentum is unstoppable. Keep an eye on Focus Graphite. Put them on your hot list. You can find them on the TSXV and the symbol FMS, and on the OTCQB and the symbol FCFMS. With their high-grade projects and government backing, the sky is the limit. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before making any trades, and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.